Exercise 1019 will hopefully help you understand how some of those balances got in to exercise 1012. What we have here is a bond that was sold at a discount. Notice these bonds have a face value of $300,000. However, we sold them for $290,000. And the reason for that is that the market rate of interest was different than the stated rate of 8%. In fact, the market rate must have been higher, so the only way we could entice people to buy our 8% bonds when other companies' bonds were paying a little bit more than that was to knock the price down. Now, here's the thing. At the end of 10 years, we're going to have to make a $300,000 payment. So this carrying value has to gradually move from $290,000 up to $300,000 over the life of the bonds. Now, this is what the author referred to as amortization of discount. And in this problem, it says that we're going to use straight line. Now, what straight line means is that we're going to go from here to here, $10,000, evenly over the life of the bonds. Now, because these are 10-year bonds, the amount that we're going to amortize each year is going to be $1,000. Now, what we mean by amortize is we're going to add $1,000 of carrying value to that bond every year for 10 years, and that's going to cause the carrying value to go from $290,000 up to $300,000. Now, cash payments, there's nothing we can do about these amounts absent buying bonds back once the bonds are sold. So these bonds are sold and they have a face value of $300,000. They have an 8% stated rate, so we're going to have $24,000 as our cash payment every year. That bothers me having that thing out of whack there. Okay, every year for 10 years. So I'm just quickly filling these amounts in, and regardless of what those bonds were originally sold for, this number is determined by the face value and the stated rate. So it doesn't matter whether I sold these for a premium, discount, or whatnot, this is going to be $24,000 because of the amount of the bond. Now, here's the thing, interest expense. Remember now, this amortization is going to increase my carrying value. In fact, if I take this plus my amortization, notice it's $291. If I copy that down, that carrying value is gradually going to increase over time. Now, the only way that carrying value, which is basically my loan balance, the only way my loan balance can go up is if these payments here are not enough to cover my interest. So my interest has to be greater than my cash payment. And under straight line amortization, my interest expense is going to be greater than this cash payment by exactly the amount I want my loan balance to go up each period. So this is going to be $25,000. So every year now, this is going to be $25,000. Notice where the name straight line comes from, is that straight line means the same amount every year. Notice my total interest expense is $250,000 over the 10-year period. That's because I paid out $250 or $240 with my annual payments, but I also paid an additional $10,000 amount at the end over and above what I had borrowed at the beginning. So that $250 divided evenly over 10 years is $25,000 per year. My journal entries on the date that the bonds are issued, I'm going to make a debit to cash because that's the amount I received. My bonds payable account is always credited for the face amount. Obviously these aren't equal, so I need a debit, and that debit is going to be to my discount account, and that's going to be for $10,000. This is what's referred to as a contra liability. If I take $300,000 minus this contra liability of 10, that gives me my initial carrying value of $290. Now we get to the end of the year. In this case, the payment is being made on the last day of the accounting period. So I make a credit here to cash. My interest expense is $25,000 from my amortization schedule. And now what I'm going to do here is credit my discount account for the difference, or $1,000. This $1,000 comes from right here. Remember, this $1,000 represents an increase in my loan balance. Increases in liabilities are credits. That's why I'm crediting the discount account. Notice one other thing here. My discount account will now have a $9,000 balance. So if it has a $9,000 balance, $300,000 minus $9,000 gives me my carrying value on the end of the year, or at the end of the year. This number is what would appear on the balance sheet on 12/31/2010. This is my interest expense on the income statement for 2010. This number would appear on my cash flow statement. Then part C says, what's the journal entry way down here? The last interest payment has been made, which means my bonds payable has a carrying value of $300,000. There's no more discount left, so there's going to be a cash payment of $300,000. A little bit tougher problem, that discount. Notice how when bonds are sold at a discount causes the interest expense to be more than the cash payment. If we had had a premium, then interest expense would have been less than our cash payment. Hope this helps.